Maxwell. I'm an investment specialist with Baillie Gifford and Scottish Mortgage, which is one of the UK's largest investment trusts and Baillie Gifford's longest standing client. And as you can see, the topic of my presentation today is what makes Scottish Mortgage a distinctive investment. I've been with Baillie Gifford for 8 years, before which I was an officer in Royal Navy submarines. And I'm often asked what life is like in investments compared with submarines. And in investments, the food's a bit better. There are usually more windows, although conference venues are the one exception. And when you're a trainee, they don't make you sleep among the torpedoes. But there are some similarities. In both cases, you need discipline and a good plan. And in both cases, you occasionally come across instances where a good upward course, called growth in investments, and called a bow-up angle in submarines, can suddenly and for a moment become a bow-down angle. And in investments, as in submarines, the feeling in your stomach can be quite similar. But again, the important thing is that discipline and looking where you're going and doing what you can to get back on that track. The relationship between Scottish Mortgage and Baillie Gifford goes back over 100 years, and it has created very good long-term returns for our investors. And as we saw on the slide earlier, past performance is no indication of future performance, but it is pleasing for us to have been able to deliver good long-term returns. Apart from inevitable moments of volatility and adverse sentiment, the 1970s oil crisis, the dot-com bubble bursting, the global financial crisis, and then post-COVID. Apart from inevitable periods like that, Scottish Mortgage has been very much a bow-up investment over the long term. And most importantly, what we believe, looking forward, is there is upside ahead for the patient investor. That is our firm contention. So our purpose at Scottish Mortgage is simple. That's to maximise total returns over the long term. And we aim to do so by investing in creating a liquid and low-cost portfolio of exceptional public and private growth companies. And the businesses we want to own are facing large and growing opportunities. They have strong competitive advantages. They're often disrupting industries or creating brand new industries. And they tend to be founder-led with a cultural advantage too. However, exceptional growth companies don't change industries or create new ones overnight. It takes 5 to 10 years or more, and there will be mistakes along the way. And that's why our responsibility as patient and supportive shareholders is to understand that and keep the long-term view. But of course, that's not always easy. Humans aren't naturally very patient. We often prefer immediate gratification. And after all, through our very, very long history, that tended to be what mattered the most. The time frames our ancestors had to think about in terms of agriculture and hunting were the 4 seasons of the year. So perhaps it's no surprise that the stock market is so obsessed with short-term cycles built around the 4 quarters of the year. But this innate short-termism jars with the requirements of the modern economy. So in the age of capitalism and in the age of industry, and indeed in the age of longer life expectancies, investments must be made over a multi-year, even a multi-decade horizon. Converting new ideas and new technology into growing businesses takes time. But if successful, the rewards can be profound. We believe that good growth investing requires certain characteristics which can be hard to find in the investment industry. I'll make the case that Scottish Mortgage does embody certain characteristics which do make it a distinctive opportunity. And these characteristics are listed along the slide here, but I'm going to go through them in turn now. We are not interested in the status quo. We are interested in the future, we are interested in growth, and we're interested in new ways of doing things. Okay, so the first characteristic is seeking outliers, and I encourage you not to try to read every single line of the slide here. I'll talk you through the big picture. The asymmetry of stock market returns is very, very clear, and it should inform decisions about equity investing. Now, the stock market is made of thousands and thousands of companies, but returns are neither evenly nor normally distributed across every company in the market. Rather, returns are driven by a few big winners. They are asymmetric or they are skewed. And the extent of this skew often surprises people. A study by Professor Hendrik Bessenbinder out of Arizona State University which looked at all of the listed companies globally since 1990. And of the 61,000 listed companies globally since 1990, 61% of them underperformed T-bills, which are US government short-term bonds. 38% merely offset that underperformance, so 98% of the market gave you the return of a US government short-term bond. And only 1.5% of all listed companies created all of the wealth above T-bills, which was $44 trillion. Okay, so that skew is present in the long term of the stock market, and I think it's important to recognize it. Now, to invest in the biggest winners, you can invest either passively in the entire market, and you're guaranteed to own the biggest winners. Like, you won't miss them, but you will dilute your returns with the 98% of the market that does equate to T-bills. Alternatively, you can back a stock picking process that aims to invest in just the biggest winners. And if you're successful, the returns might be exceptional. Asymmetry has been at work in the Scottish mortgage portfolio. Our good long-term returns have been driven by a few big winners. Now, inevitably, we experience some losses in individual holdings. This is an aspect of equities investing, risk versus reward. And for instance, Northvolt, one of our private companies in the battery industry, has recently struggled through lower than expected demand and problems ramping up. And they have a very, very steep road ahead to fix things. Now, that shows among our biggest losses, and I'm sorry if you can't read that at the back, but basically that's just a line there of our biggest losses over the longer term, a 1x loss, if you will. However, the maximum you can lose in one company is that 1x. Compare that, though, with the potential of the biggest winners, which in equity portfolios, long equity portfolios, is theoretically limitless, theoretically. Now, in practice, what that meant for us is NVIDIA, one of our holdings in the artificial intelligence and semiconductor space, has delivered 87 times our original investment. Tesla, we've owned since 2013, has returned 20 times. ASML, a semiconductor company, and Ferrari, each over 10 times. So our biggest winners, again, past performance is no guarantee of future performance, but our biggest winners have substantially outsized our biggest losses. And this is what we mean by asymmetry in the market and asymmetry that you're looking for in portfolios. Now, the best performing long-term companies are also very often the most volatile in the short term. For example, we can see here the growth of NVIDIA on the left and Spotify, the audio streaming platform, over the periods we've owned them. So good long-term growth has been periodically punctuated by these, you can see them in the orange bubbles there, periods of volatility, periods of drawdown. Now, the reason good long-term investments are often the most volatile in the short term is because different variables and different drivers play out over different horizons. So long-term share prices follow profits, and that's because investors wish to own the biggest cash flows. So companies that grow their profits 5 or 10 times in a decade can be worth much more as a result. Whereas over the short term, share prices are much, much more unpredictable. Now, this is because, and I'll state the obvious, because it's worth doing sometimes, future profit growth hasn't happened yet. So we're dependent on the market to forecast it. And the market's willingness and its ability to forecast profits is affected by all sorts of things, by the emotions and the sentiment of news, by trading volumes, and by lots of unpredictable politics and economics. And so here's this idea that to seek the best rewards, the best long-term growth, we need to be patient, even during inevitable periods of adverse sentiment. And that's at the company level, and that's at the fund level in our experience. If you want to invest in, if you want to pick the biggest winners, one approach is to look for the few companies which are driving valuable change. So this is the second of our characteristics. There was the opportunity in asymmetry, and now here's the idea that change can drive growth. So change means things like new science, new technology, being incorporated into new business models to meet new forms of demand. And the potential link between change and returns was once called creative destruction by the economist Joseph Schumpeter. And it is the intuitive combination of two facts. One, again, profit growth drives share price growth over the long term. And two, Consumers prefer to spend their money on new and improved products and services, and there are a few companies that go about providing it. So if you think about the valuable industrial revolutions that have gone before us, so steam, electricity, flight, computers, and now think of that process as ongoing. Artificial intelligence, genetics, robotics, connectivity. Industrial revolution is a living thing, and today the stock market is worth over $70 trillion, so it's an enormous amount of money, but most of its thousands of companies are facing the potential of disruption by a few innovators. And here is a really, really exciting opportunity for investors. And on the screen, we have examples of some of the growth trends, the trends of change in the Scottish mortgage portfolio. For example, and we are, I think, distributing these slides afterwards, by the way. We have the digitization of finance with investments in Stripe and Wise. We have transformation in healthcare with the likes of Tempus and Recursion. And we have evolutions in transport with electric vehicles, Tesla and BYD, drone delivery company Zipline, and air taxi company Joby. So here are companies driving change and seeking to take market share as a result. So a bit of a deeper look into one of the examples. So I picked artificial intelligence, or AI. Now, after decades of science fiction and years of investment, AI is here, and it is changing societies and economies around the world. Innovation drives profits, and AI has been a contributor to recent market performance. Now, phase one is the hardware that makes AI possible. So it's the microchips, it's the semiconductors. And at the heart of this supply chain, you have three of our holdings: NVIDIA, ASML, and TSMC. NVIDIA designs the best chips for artificial intelligence. TSMC then makes the chips for companies like NVIDIA, and it does so using ASML's leading-edge machinery. Next in the supply chain, you have infrastructure. So these are companies that are using chips to create the huge AI models. And they include cloud providers, network infrastructure, data analytics, and security companies, security software. And Scottish Mortgage has a range of investments in this phase too. So Amazon, Snowflake, and Databricks. And then we have the companies that are applying AI to their business models to grow revenue and improve their productivity and margins. In our portfolio, there are many examples, and including artificial intelligence for robotaxis and autonomous driving, and also for drug discovery. Lots of other examples too, of AI creating change and therefore driving growth. The third characteristic that we find advantageous is our structure as an investment trust, which we've had for over 100 years. So as a closed-end fund, and that basically means we raise a certain amount of capital with a specific amount of shares, and unless we're changing that number of shares by actively selling or buying, it's that capital that's invested, and it's those shares of ours which are traded on the market. Now, because of that closed-end structure, we're protected from certain cash flow pressures, which allows us to focus on our long-term investments, and that really, really matters to us, without the need to sell or liquidate our assets prematurely. We do employ some modest gearing, some modest borrowing to enhance returns, and it's always worth remembering that returns must exceed the cost of borrowing to help and not hinder, but our careful management of gearing has historically contributed to our returns. We aim to actively manage our share price around net asset value, around the value of our portfolio, through issuing shares and through buying back shares. And like the rest of the trust sector, Scottish Mortgage has been in a period of greater than usual discount recently, and the board therefore has been actively buying back shares, and we have been seeing that discount narrowing. As one of the UK's largest investment trusts and a member of the FTSE 100, liquidity is there when you need it for buying and selling, and we keep our costs low. So we charge 0.35%, which is below the industry average for active and for private equity funds. So our investors keep more of any returns that are generated. Our structure also allows us to have up to 30% of our portfolio invested in private companies. Now, private companies are themselves illiquid, so they're not regularly traded. It's not that easy to convert back into cash. But our closed-end structure allows us to pick what we think are the best private companies and then offer an investment in a liquid form, in a readily tradable form. So Scottish Mortgage, therefore, aims to offer something unique, something distinctive, which is a liquid and low-cost portfolio of exceptional public and private growth companies. And this brings us to our fourth characteristic, which we think makes us a distinctive investment, which is our private companies exposure. So many growth companies are now staying private for longer. So the relevance of private companies has been increasing to investors. The average age of an American company at listing was about 8 years in the year 2000, and it's nearer 12 years today. And the amount of value created by late-stage private markets was about $10 billion in 2006, and it's nearer $2 trillion today. So for us, whether it's growth of late-stage private companies or growth of listed companies, what we're looking for is the best growth. And we seek to avoid an arbitrary distinction between growth we can and cannot own based on being listed or not. So our blend of public and private companies is exposure across more of a company life cycle. Private companies are currently about 23% of our portfolio. This includes some of the most successful private companies in the world. Our largest private position is SpaceX at around 4.5% of the portfolio. Now, SpaceX is spearheading low-cost space logistics and satellite connectivity. We have ByteDance, which is the world's largest private company and the owner of TikTok. I'm not sure if we have any budding TikTok stars in the audience. I didn't see any of those dancers at the back, but I'll not ask you to raise your hands. But ByteDance is changing how content is created and consumed. And we also have Stripe, which is digitizing payments and making inroads towards cryptocurrency. Our private portfolio also has strong fundamentals. So half of our portfolio, that part of it, is already positive in generating cash flow, or you can see the next couple of years runways towards being profitable, and that's only at the bottom there, with healthy cash balances as well. So we aim to offer, it's what we think is a very exciting private portfolio with strong fundamentals and high growth potential. And that's why we think it's worth including. Even if equity portfolios wish to own the most exceptional private companies, that doesn't necessarily mean they can, because private companies get to choose their investors. That's a key difference with public markets. So our reputation as long-term supportive shareholders with a strategic focus often makes us preferred investors for private companies. So many company founders approach us directly or through introductions. It was Tesla, for example, who introduced us to the battery recycling company Redwood. And we really want to be the manager that companies want to introduce other private companies to. Because we think it gives us access to high quality deals and long relationships with visionary entrepreneurs. We've got a well-resourced private companies team at Baillie Gifford and a rigorous valuation process we think our investors can trust. The final characteristic which we think makes us distinctive then is our mindset, and we aspire to be curious, patient, and brave. Curiosity matters because to beat the market, you have to take different views to the market. That's really, really important. So we do not focus on consensus and the short-termism of the finance industry. We seek broader information sources. Patience matters because, again, you don't create valuable change overnight. It takes 5 to 10 years or more. The evidence shows the market does have a very short-term view. There's a number of different points of evidence you can point to. Our average holding period over 5 years is an average of 5 years is much nearer 10.5 years, average holding period. And bravery matters because, remember, reward comes from taking risk. So we must be brave enough to stand apart from the market and back our beliefs even in the face of criticism. And that's the output. So I'll point to this bit here, sales and earnings growth in our portfolio, which is 2 to 3 times greater than the benchmark on a forward view. And that matters because as we've discussed a number of times, earnings drive growth. So thank you very much for listening to my presentation. It's great to see you all. And if you have any questions, I'll see you at the stand. Thank you very much.